Let's move on to this MSCI report. Prices of U.S. commercial property tumbled in January, just what we were talking about. But this is actual, not predictions. What's already happened? Apartment tumbled.
Yeah.
Apartment tumbled.
Apartment was down 4.6% from a year earlier and was down 2.8% just in 1 month. I think that's a lot. I think that this is sooner than I expected to have movement in apartment prices like this, considering, it seems like these sellers aren't budging, but some of them are. And this is a natural result. And I think that I don't know if it was a long time coming, but it is definitely a sign that at least some people are bringing their prices down. Some people need to sell.
And this data, I think, is still very much lagging. And again, these are transactions that went under contract a quarter plus or more ago. They closed in December and January. They're working on a midsummer, but just I'm going to say anecdotally, it's not 4.6. It's 10 to 15.
Yeah,
it could be 10. It could be 20 in some cases. Now, there's not a ton of price discovery, but I can just tell you when we're looking at deals, we're 15, 20% below what's typically being asked. And what's being asked was the price that we're trading a year ago.
Yeah.
And it's not like there are buyers jumping in and winning the deals that we're, bidding 15, 20% under. Everyone's in a similar place as we are. No one's getting their ask right now.
Yeah.
So this is a little bit of lagging, which makes sense. Again, all the pricing data is behind, and some of my pricing data is also like deals that don't go through. But it's I know what the bids are and are not.
Yeah.
And they're not coming in at the low cap rates they were.
Yeah, I thought that was definitely meaningful. Apartments were such a juggernaut. Even through 2022, people were calling the devaluation of the CRE market the minute that interest rates started rising. People saw this coming. They just didn't want to budge. No one wants to budge. They started, but they're getting there.
Well, it reminds me, and I was thinking about this this morning on the drive in. It just the whole idea of don't fight the Fed and real estate investors back in 2020 and 2021 were keen to say as a reason to invest is don't fight the Fed. They're lowering rates. They're telling us to buy assets, take on this debt. It's time to do it. Don't question it. Just do it.
Yeah.
Take on the debt. And now we're not listening. Now we don't want to listen to the Fed. Literally, the Fed's real estate, probably needs to be brung down a long lug, and rates are going here, and people are like, oh no, I'm still going to put a floating rate adjustable loan on it.
Yeah,
I don't believe the Fed. They're not going to. They can't. There's no way they can raise them that much. It seems crazy. And even though like they're communicating this is what we're going to do.
Yeah.
There's like a dot plot. Here's the course, but people are like no. Now it's oh well, rates less than this now, but rates will be lower near the end of the year. The cap rates are going to come down, and I think that those things, again, this comes to timing. Those things will happen eventually. I don't think they're happening this year. Yeah, I could be wrong. Again, back to me not being very good at timing things, but real estate is a slow and moving industry. It's a big boat. So like to turn it around so quickly and get all the buyers mindset.
Yeah.
Like turn to realize what they have isn't worth what it was last year.
And that's what
be told that.
Well, I was thinking about, and it's a little bit related to like multifamily starts versus single family starts. There's going to be a lag indicator. There's going to be a little bit of a lag for multifamily. That's a big project.
It's huge.
But residential, for building a house, that's just one person. It's a little bit easier to stop on a dime if things aren't going really well. But yeah, that's a big machine. You may be forced to continue with a project because you've sunk so much cost and time and energy trying to get things approved, especially kind of on the development side, and then you find yourself on the wrong side of rates. But again, if you have a long enough time period, maybe you can figure out a way around that. Yeah. So sometimes maybe the cure for something slow moving is to give yourself more time to deal with the things that
100% definitely gives you a lot more options.
Yeah,
that's for sure. We got minutes that came out from the Federal Reserve. We were talking about last week. They hadn't come out just yet. We were anticipating them to come out. So FOMC, Federal Open.
Last week they released these. We're about a week late, but they're still very much jibe with a lot of the discussions that were happening. It was almost like they released these minutes, and then there were a bunch of different sources and reports that were kind of covering them and breaking them down and expanding on some of the ideas specifically that they rose. So I think that the headlines in some of those reaction articles were focused on maybe one passage specifically, which I'll quote here. It says, "The staff provided an update on its assessment of the stability of the financial system and, on balance, characterized the financial vulnerabilities of the U.S. financial system as moderate. The staff judged that asset valuation pressures remained notable. In particular, the staff noted that measures of valuations in both residential and commercial property markets remained high and that the potential for large declines in property prices remained greater than usual." Later, the notes mentioned vulnerabilities in the financial system associated with higher interest rates, including the elevated valuations for some categories of assets, particularly in the CRE sector. I think this is their red flag, and they're using it. They're almost couching it in this word that's elevated. Oh, they were already high already, and we're just going to knock them back down. At least they don't characterize the effect of higher interest rates as returning to normal, but it's a small comfort to CRE owners that the Fed's notes describe falling valuations as a vulnerability. I think this is if you read it in a certain way, it's a way of them saying, like, get ready. We could really
and Jay Powell has made comments, all the way back to last summer of basically saying, the real, there was should be some pain in real estate based on where it was. And said, like, hey, if you're looking to buy a house right now, maybe I'd wait a little bit. I think prices might be lower. So they haven't stated that knocking the housing market down a little bit as part of their goals, but I think that is part of that, of just one area of the economy that's really seen some heat over the last couple of years. So it's definitely time to be cautious, especially in those markets that have seen those really crazy run-ups.
And another thing that was released, and we'll get to it in just a second, was some of their stress tests. But at least in the minutes of their meeting, more than the stress tests, they really talk about this inflation danger, and they don't want inflation to become unanchored. They don't want it to be untethered or unmoored from the steady hand of our betters at the Federal Reserve.
Exactly.
Here's what I think. What I can only hope is that the Federal Reserve, at the same time that it's thinking about prices like unanchored boats swirling into a vortex, maybe the Fed also thinks about the lagging effects of interest rate increases. So some assets and some markets are going to react quickly to these interest rate hikes, and some it's going to be a long time coming. So we've talked all about these anchored.
Do you think they don't know?
I think. I think that they're,
okay, so let's say, Matt, you and I are, okay, our knowledge is what it is. We have a YouTube show. Do we own and operate a couple, thousands of apartment units? Yes. But I'm just, look at all these fancy folks on here, really nice titles. We got a big staff of folks. You think that, like, this can't be news to them, right?
Well, I think it's a question of priorities. And they know about it, but they've got a lot of other things to worry about. And if this thing is happening too much in the future, it's easy to not really.
They've got a lot of things to worry about. Yeah. But isn't this like a pretty important thing to worry about?
Well, for whatever reason, it seems like they're. I get the feeling that they don't really care as much about the threat of lower CRE prices as much as the threat of unanchored.
For sure. Inflation. For sure. Yeah. Yeah.
It's like, this is what we have to do to bring it down.
Yeah, they don't care about they don't really care about asset prices unless it starts to actually affect their balance sheet or their mandates.
When it comes to their stress testing, I think that it's a little bit different. And they did provide some updates to their baseline and their severely adverse test scenarios. On page 21 and 22 of the PDF of the stress test, and we're going to include that link in the show description, there's the full stages, but essentially the adverse scenario is one in which a widespread recession sends employment down, interest rates down, inflation down, but asset prices down as well. Even though CRE asset devaluations would be strongest in the office and hotel sectors, all of them are expected to go down. Some nearly 40%, overall CRE, and nearly like 37% for multifamily. Really, I think that this is their worst in and I'm not sure exactly how what their dictates their adverse case scenario, but it seems like, at least in this one, their adverse case is, we hiked up interest rates so much it caused a recession, and this is what's going to happen. It's almost like, hey, you want low inflation? You want low interest rates? We'll give you low everything. We'll give you low employment. We'll give you low money. and in that case, it's like, it is a real nightmare scenario, and it doesn't seem as likely as their baseline. Their baseline is almost kind of interesting because it's showing, oh, this is what they think is going to happen. Otherwise, it wouldn't be a baseline. So with that being said, and you can see the adverse scenario is definitely like low everything. Baseline features an initial slowdown and then a gradual recovery. The unemployment rises steadily from just over 3.5% at the end of 2022 to near 5% by the first quarter of 2024, and then it goes down from there. Real GDP growth declines a little bit, is negative 3/4 by the middle of 2023, and then gets to about 2.25% by the second half of 2024, and kind of settles in from there. Inflation is it steadily goes down from a little less than 3.25% to a trough of maybe 2% in the second quarter of 2024, but hovers around that area. And the 3-month Treasury rate increases from around 4% at the end of 2022, around 4.75 max in the second quarter of 2023, and then it goes to about 3% by the end of the scenario. So basically, it is no catastrophe, but it is a tapering. It's not like they're snapping their fingers and everything's going back to normal. They also anticipate things will get a little worse, then a little better, then a little normal. So they're even seeing some ripple effects. I think that the headline for the adverse scenario, this enormous 40 or 37% asset devaluation, depending on what assets you're holding, that's really the scary headline that everyone kind of glommed onto. But
they can't not put that out there.
Yeah. And what was interesting about that is that actually that low point happens in Q4 2024. So it's not like assets would decrease.
It takes a while.
Yeah.
Makes sense. Yeah, makes sense. Yeah, no, I think the Fed's is in a tough spot right now because they're not going to be able to get inflation under control at unemployment rates so low. And we just had another, jobless claims number that came out, I believe, this morning.
Yeah.
And still, it's like 190 some thousand jobless claims, which is basically nothing. A drop in the bucket. And we still have an incredibly tight labor market, and they're not going to be holding up anytime soon. And they're going to have to break some things.
Yeah.
Like the labor market and maybe part of the real estate market and some other markets to get unemployment where they and as high as to get it to that 5%.